Well, hello, everyone. And on behalf of BVR, I want to welcome you to today's webinar on extreme uncertainty, how valuation experts should respond to today's volatility and risk. I would like to introduce our panel. We have four individuals on our panel. First up, we have Stacy Collins. She's a managing director at Financial Research Associates, and her experience includes marital dissolution cases, corporate litigation, estate planning, valuations, and transactions. We next have Michelle Gallagher, who is a strategic partner with Adam Valuation, where in addition to serving clients with valuations for tax and other matters, she leads the firm's family law practice. Harold Martin is the partner in charge of valuation and forensic services for Kiter, and he is an adjunct professor at the College of William & Mary Graduate School of Business. He's also the co-author of Financial Valuation Applications and Models. Gary Trugman is president of Trugman Valuation and is the author of one of the preeminent textbooks in the profession titled Understanding Business Valuation, Practical Guide to Valuing Small, medium-sized businesses. I'm going to let our panel at this point make a few opening remarks and give some initial thoughts and perspectives. So, Stacy, if we could start with you, please.
Sure. Thank you, Andy. Hi, everybody. Thank you for joining us today. I think this is going to be a great discussion. In prepping for today, a couple of thoughts keep going through my head. I, like probably a lot of you, lived through the Great Recession in 2008, 2009, and spent a lot of time back then trying to think through a lot of the issues we're going to talk about today. And so I've been spending a lot of time over the last few days trying to think about what's the same and what's different. And I think that's probably something we're going to talk about a lot during the course of this call. The other thought that I keep thinking is, how can I factor in the effects of all this without somehow double counting the effects once I start toying with various assumptions? So I'm sure we'll get to that too.
Thanks, Stacy. Michelle?
Hi, everyone. Good morning, good afternoon, wherever you are. It's great to have so many of our BV community on this, as well as other financial professionals, attorneys, business owners. This is going to be a great discussion. I'm looking forward to it. My last 2 weeks, 3 weeks have been completely absorbed with the new acts more than anything. I still do have a role, minimal as it may be, with a traditional CPA firm and still handle a lot of high-touch clients, high-net-worth business owners. And we have been sorting through these programs, the PPP loans and all this. So I think more than anything, I feel like I can bring to the table some valuation thoughts today on all of these programs, and even perhaps some family law perspective on some of the things, not only with the loans, but all kinds of action going on in these areas. And looking forward to sharing my thoughts and seeing what questions people have and what they're facing in their practices right now too.
Thanks, Michelle, for being with us. Harold Martin, how about you?
Yes, good afternoon, everyone, or good morning, depending on where you're from. It's a pleasure to participate in this webinar. As probably everyone on the webinar has been dealing with this issue, we've just started to do valuations with current dates. In fact, we had one this morning where we're having to wrestle with how do you assess the impact of the coronavirus on valuation when you have a valuation date of March 31? And we're going to spend some time in today's webinar talking about all the different issues and considerations that you're going to have to deal with and looking at the various valuation approaches and discount rates and so on. So we'll look forward to this interactive discussion, we hope.
Thanks, Harold. Gary Trugman.
Hi, everyone. Needless to say, I'm in the same boat everybody else is, just trying to stay safe and deal with all these issues that we've never imagined would happen before. I'm a firm believer that we have to go back to basics And we have to remember our valuation theory. And a lot of the discussion that we're going to have today, I'm going to try to keep driving everybody back to the fundamentals. Because I think if you remember your fundamentals of what you were taught in BV 101, it's going to apply now more than ever.
Okay, thanks very much, Gary. Why don't we kind of get right into these questions, if we may? And we've got quite a number of people on the line, so please bear with us. But this first question that we received and is very similar to a number of questions we've been getting from a lot of readers and our customers. And here it is. And I'm going to direct it to Gary. What is the consensus on what valuation dates do we start bringing in the impacts of COVID-19? Are appraisers lowering values as of December 31, 2019, for example? Gary?
Well, I think, Andy, that's a very fundamental question that we all deal with day in and day out with valuation. I think the question is, if you're doing a fair market value appraisal, it comes back to what was known or knowable as of the valuation date. We have to remember that at 12/31/19, if you were doing an appraisal possibly in Wuhan, China, you might have known about those things. Not so much in our country at that point. So I don't think we can forecast, that kind of impact. And I also don't believe that we have an obligation to report subsequent events. Because if we look at our valuation standards, they're pretty clear that a subsequent event is something that's not necessarily known or knowable. Now, depending on your valuation, if you've got a client looking to buy a business, you better bring it forward. I think that's going to change the valuation date as opposed to changing what's known or knowable. So I'll sort of toss the ball back to someone else.
Anybody. Harold, you very kindly responded to a reader of ours who was doing an ESOP valuation. Are you able to share any of that with us?
Yeah, sure. First of all, I'll follow on Gary's comments. I absolutely agree with his comment, and Gary knows it pains me to say when I agree with him. But I have to be
honest. In one day, Harold. I'm worried about you.
But I do agree it's an issue of going back to the fundamentals and considering what was known or knowable as of the effective valuation date. With respect to the issue that you raised relating to the ESOP, I think it was last week there was a comment from a reader who was valuing an ESOP and had an effective valuation date as of 12/31/19. And I responded that, they should consider that information which was known or knowable as of that point in time, and perhaps consider reporting the coronavirus as a subsequent event because their valuation report was dated March the 11th. And that is something the user would be interested in. I went on to say that the DOL proposed regs relating to an ESOP indicate that your valuation should be as of the effective transaction date. And I'm going to issue a follow-up article, as you're aware, to clarify that comment, because what I did not go on to say in that initial article is that that user probably should prepare what I call a bridge letter updating the valuation as of 12/31/19 to a more current date close to the effective transaction date of the ESOP. Again, particularly given the guidance of the DOL on that issue.
Andy, one other thing that I wanted to throw out there, unrelated to what Harold just said, but touching on what Gary talked about in terms of the known or knowable, is the question of whether you have a December 31st, 2019 valuation date, but you're issuing your report now, meaning the report is dated in April, but you have this older valuation date. I've heard people talk about the fact while you may not factor in the subsequent events, I'm totally agree. It was not known or knowable in almost any part of the world. Whether you might want to have a sentence somewhere in your assumptions and limiting conditions affirmatively saying that this does not factor in the effects of COVID-19 as it was not known or knowable, just so the reader who may not necessarily understand the concepts, the standards that we all abide by, they may not understand without seeing that explicitly written that it wasn't factored in.
Andy, I want to jump in for 1 second because, feeding off Harold's remark about the ESOP valuation, one of the things that people tend to forget is that while an ESOP gets valued once a year, it also needs to be valued at the time of a material transaction. And getting closer to the transaction date, I think that we have an obligation, the COVID-19 impact on certain companies may have a material impact on that company. And I think that in itself could trigger the need to do a different valuation. So I agree with Harold. I'm a little reluctant, though, to start putting limiting conditions in the reports. And the only reason limiting conditions and subsequent events scare me. As an accountant, one of the firms that I worked for years ago was a firm named Max Rothenberg and Company. And it probably doesn't mean much to a lot of the people in the audience. But for those CPAs that are out there, Rothenberg got sued many years ago for doing unaudited work before the accounting disclaimers became the norm. And one of the problems, the reason they lost their lawsuit was everything they were doing looked like an audit. I don't want to do things in valuation that make it look like we're doing something that is not a valuation by disclosing subsequent events. And if we're going to put a limiting condition in, does that mean we should be putting a limiting condition in on every kind of infectious disease or unknown circumstance? It gets to the point where how much do we put in a report?
Let me pipe in. I can tell it's going to be hard to get a word in edgewise with this group today. So we spent a lot of time in our shop looking at the disclosure, if we had a requirement or if we don't have a requirement. We did look to SSVS, and for those who haven't looked at it yet, there is a specific section in SSVS specific to subsequent events. So I would encourage everyone, at least if you're an ABV, that you should be looking to SSVS for some guidance. But our conclusion in it is that even for December 19 report, we feel it's important to put something in the report disclosing that we did not consider the impact because it was not known or knowable. We made a decision not to put it in the assumptions and limiting conditions because, frankly, most people don't read them. Truth be told, right? So we've been toying with where in the report to put it, and I think we're concluding to put it more in our cover letter or transmittal letter that the report goes with, just to identify certain dates that we do know of, and that because it's December 31 is our true effective valuation date, that the impact of it is not included, but we are aware of it. So that's what we've decided to do in our shop at Atomy.
Hey, Andy, can I make one follow-up comment also?
Yes, sure.
I'm going to depart from agreeing with Gary now. We do believe that this should be reported as a subsequent event where you have an effective valuation date that preceded the adverse impacts of the pandemic. I always use the example of a fire. If you were valuing a company at 12/31/19 and there was a fire on January the 1st, 2020, and your report date is January the 15th, I think it would be meaningful to the user to be made aware of the fire as a subsequent event in that report. Even though you have an effective valuation date of 12/31/19, the fact that there was an event subsequent to that is going to be of interest to the user of that report. And it's analogous to this situation. I would argue that knowing the effects of the pandemic is meaningful to the user and therefore should be disclosed.
Great, thanks, Harold. While you were talking, a question came in from the audience. Let me read it out. With respect to a 12/31/19 valuation, you may have the ability under the law in your state to also present an updated valuation based on the impact. More of a comment than a question. Any response to that?
Well, I think there are certain states, and especially we see this in a lot of the matrimonial litigation, certain jurisdictions require the date of trial to be used for the valuation. So we're constantly updating our valuations as we get closer to trial. I've got a case going on right now, where the business effectively is shut down. Well, what's the value when the business is effectively out of business right now? So I think in those situations, and very often it's a matter of equity, you're always looking to update the date. And that gets back to not what's known or knowable. It gets to what's the valuation date. And the date gets moved. So as soon as you move the date, what's known or knowable changes. Mm-hmm. So I agree with the individual that sent in the comment.
Okay,
yeah,
thanks.
I think we all agree in any litigated cases, certainly if you're on the side of a business owner, and this isn't necessarily just matrimonial, but if you are a business owner, and there's some on the webinar, there's some of us who own our own practices, would you settle for a number right now based on a 12/31/19 value? I don't see it happening. So I think we're going to be forced to do either multiple valuation dates, which is, I suppose, good for our business, right? But I think we're definitely going to be faced with some challenges in the valuation date choices.
Andy, I would respond to that question a little bit differently. I think it depends on the type of litigation. For example, I understand Gary's and Michelle's comments with respect to divorce, because we have a similar law here in Virginia. But for other types of cases where you have permanent diminution of value that would require a valuation, again, you would be looking at the date of harm as the effective valuation date. And given that valuation uses an ex ante approach, you only consider that information which was known or knowable as of the date of harm. And again, if that date of harm was 12/31/19 or earlier, you would not reflect the impact of the pandemic.
Great, thanks.
And Andy, I would just add one more thing, and I think we all know this, but to the extent that we add more current valuation dates to evaluation in a litigation setting, I think we could all agree that would be something that counsel would instruct us to do. We're not determining the valuation date. We're having counsel tell us what that is depending on the nature of the assignment. Right.
Just as a matter of a note for our audience, in the reading materials page, we have a COVID-19 timeline. I know there's one on there that was published in the New York Times, but we also have one that was sent to me by Bob Morrison of Rosenfield and Company, a valuation firm. They did a very detailed, and I'm not sure if it's on the reading materials page, but we'll get it on there or get it out to everyone. And he asked me to share it with people. It goes back to November of 2019, fully footnoted. So they're using that as a kind of a tool to help them with this known and knowable issue. Which, while we're talking about that, why don't I launch this second poll of ours? We've got some different dates in here, and then we can maybe talk about what you're doing with these subsequent dates. But the poll is up there now, and let's get an impression of what people think. When were the real effects of the virus known, knowable, or reasonably foreseeable? The poll is up there right now, and please respond. But so it brings up the issue of these later valuations, and what are you doing in those regards? Maybe Gary, we'll start with you. How are you starting to layer these effects in there?
Well, I think, Andy, it's no different than anything that we've done historically. I tend to look at, when I speak with management, one of the first questions I have is, how has it impacted the business? And has it? And when did it? So that I understand, was the impact felt because of our government telling us to stop all non-essential businesses and stay at home? Or was it because your customers were impacted, or you had to close down your manufacturing operation because it was over in China? So I think every situation could be slightly different as to the impact when you're looking at the forecast for the business. I think when we look back years from now, hopefully when we look back from years from now, and we start looking at what's gone on, we may treat this period as an aberration, and we may throw it out altogether if the businesses are able to bounce back in reasonable time.
Well, we looked at the market itself to see when did the market show signs of the impact. And the first day, anyway, of the drop is right around February 20th. The biggest loss day was thereafter, but the market really started responding negatively anyway, right around February, right around the 20th, 21st. So we started looking at that date, and things that are anytime after that, for sure, there's been market impact. The question is all the time period between December and today, and how do you filter and factor all of that in? I think Gary's point is spot on, that you really just have to talk to the business that you're valuing and how it impacted them. I mean, just because the market went down 30% in the last month doesn't necessarily mean the business you're valuing did. So we just have to be very, again, back to basic, talk to the business owners.
One other that's worth mentioning, while you're talking about the market, let's remember those folks that value small to mid-sized companies, they're not impacted nearly as much by what happens in the stock market as that mom and pop store, that hair salon who's been told shut down. So, whether the market or not, the market's been going up and down with huge swings. We're in a very volatile public market. We'll talk about the guideline company method as a separate issue. But when you're looking at the overall dates, you really have to look at the subject company in order to really say what's known or knowable and how did it impact that particular company.
That's true. Although I guess one thing to keep in mind, just filtering in what both Gary and Michelle said, is there were a lot of key things that happened in a really short period of time. I mean, Michelle, you're right. I mean, right, February 20th is right when the market started to go down. And then the following week, I think the 24th is when it really started taking a nosedive every day, down 5%, 10%, et cetera. So that week has a lot of my attention for sure. But within a couple of weeks of that, 2-3 weeks, there were a lot of states that were already shutting down and businesses. So we can debate whether it was end of February, beginning of March, middle of March, but that's all a really short period of time when things were happening to a lot of people. What it means within that, I guess, is a case-by-case basis, but good and bad. I mean, most businesses, I think, were affected within a really narrow window, I would suggest, at least in most parts of the country.
Yeah. I guess to follow on the earlier comments, you have to separate the issue of when the knowledge of the disease was known or knowable, if you will, as compared to the economic effects and ultimately the effects on an individual company within an industry. I would agree with Michelle that probably sometime during the latter part of February was when the pandemic began to impact the markets. And I would therefore use that as sort of the beginning point of when that was known, or that event was known or knowable. And then with respect to the individual companies, going to Gary's point, I do agree that you are going to have to look at each company on a company by company and industry basis, because you have to look at the effects of the pandemic looking forward on how it's going to impact their supply chains, their revenues, their margins, et cetera, et cetera. It all flows from there. But then you have to project forward.
Right.
I had a case in January, actually, with a supplier in China, and they were already hearing from China in January about some supply chain issues and getting some of their product. And so I was, in that particular case, it was a family law case. I was working on the business owner side, and he was just adamant about redoing the valuation forecasting, especially for this year, because of the supply issue he was going to have. And that was the case in January. We mediated late January in that one. So our market here hadn't even reacted at all to some of that supply information, especially from the Chinese, was starting to come in January. So just be mindful of that when you're talking to your business owners, and ask them, when did they start feeling the pain from even the Wuhan results?
Speaking of the February date, the results of our poll we just ran, 51% of the audience felt that the effects were known or knowable by 2/29, 2020, 29% by March 31, 17% by January 31, and 2% as of December of 31. But like you pointed out, depends on where and it depends on your subject company. Speaking of these projections, now what do you assume in the sense of recovery, and what industries, in fact, a question from the audience, what particular industries may have differing impacts to this? And so what are your assumptions on recovery, or how do you approach that? Gary, you want to start with that?
I wish I had a crystal ball, Andy. I mean, that's a tough one, because, obviously there are going to be certain industries you almost have to question, will they ever recover? In the hospitality industry, and airlines, cruise ships. I mean, I wouldn't want to own a cruise ship right now, with everything that's going on with the cruise industry. But how do you guess at what the impact is? We've got a lot of small businesses here in South Florida that they're already talking about the fact that they may never reopen. So, it would be a guess to think about recovery at this point. You can try to speculate, but speculation is in valuation. And really, if somebody is closed right now, would anybody really buy them in the condition they're in right now? I mean, I can't imagine a fair market value buyer using known or knowable where the business is closed, wanting to step in and swoop somebody up on a guess that maybe it'll come back at a point in time.
Right. And even if a business reopens, that's no guarantee that its business will go back to what it was before. Isn't that right?
Absolutely.
Andy, could I follow on to Gary's comment?
Yes.
I think this current situation has a lot of similarities with what happened in the fourth quarter of 2008 and early 2009 during that recessionary period. I think a lot of people and analysts already had the expectation that we were entering into a recessionary economy, or would be, this upcoming year. And what happened was that the pandemic accelerated that process. Now, obviously, there are some other things that have happened. The pandemic obviously is unique in a lot of respects, but I think the situation is somewhat analogous to 2009. And the way we valued companies then is pretty much the way we're going to do it now. We're going to have to look at each company within an industry and assess their prospects going forward. And, the way that I would propose to deal with that would be principally using an income approach and doing alternative scenarios in consultation with management to develop differing projections, assuming differing assumptions. You might have one assumption where you assume a modest recessionary period with a quick recovery. You might have another that assumes a deeper recession with a longer recovery. But to me, doing sort of a weighted scenario analysis is going to be the way that you're going to have to try and value these companies.
I would, but I would guess that, we have enough trouble now getting projections from management, let alone scenarios. So how would you approach that? Would you just jump into it and make assumptions, or they're sometimes difficult enough to get as it is?
That's a fair question. Again, we look to management to develop their projections. They are the most knowledgeable people about their business and industry. I think certainly where we can bring value to the table is assisting them in critiquing the assumptions and so on. But again, we look to management to develop those and then try and add value thereafter. And yes, you are right. With unskilled management personnel, sometimes getting projections is like pulling teeth. But we have to deal with that. We dealt with it before. There's no difference now.
Well, I'll beg to differ just a little bit, because I think there's a big difference between what we're going through now and what we went through with the recession in 2008. In 2008, it was purely an economic event. And if you look at other recessions, you can study how many quarters of recession typically you go through, because recession's a normal economic cycle. We've got something that is so unusual here. The economy theoretically, depending on who you're listening to, was fairly strong before this pandemic happened. What you don't have is an ability for the government to just step in and all of a sudden pass some good infrastructure bills, get people back to work. What you've got is, you don't know how long a lot of these businesses are going to be closed down. I spoke to an attorney today in one of the Western states, and she was telling me that they don't expect their main pandemic to hit until early June. That's the forecast right now. That's an extraordinarily long time to try to forecast what's going to happen if you're valuing a company in that jurisdiction. And I think it's easier to just deal with a good economic recession than to guess at what the impact's going to be with this pandemic.
Yeah, so I think I'm going to have to jump in Gary's camp on this one. Sorry, Harold. I do think this one is significantly different than 2008-9. In fact, I remember back in the 8-9 area, Michigan actually started experiencing the recessionary times before anybody else did, even 2007, some companies even in 2006. So there was just the mere fact that had a much longer period of time of slowdown in certain states and in industries. This one is completely different. I do hope, anyway, they're right in the forecasting that this will be more of a V curve than a U curve in terms of the recovery and the downfall. I'm hopeful anyway, but of course nobody knows that crystal ball, or I told the panelists earlier today, I've got my 8 ball. I meant to grab it to shake it on here. Nobody really knows when this is going to be. Will this stabilize in 2 years? Will we be okay in a year? The forecasting piece of this is just going to be a nightmare. And here's where I'll flip back and agree with Harold. I think we're going to have to run different scenarios and stress test businesses, do some stress testing on numbers and the best case, worst case scenarios, and try to help people through these questions.
But I think Harold's point is a good one. I mean, look, it's the closest experience that all of us have to what we're dealing with, right? I mean, there was a catastrophic event that plunged all of us into recession, and it wasn't that long ago for us. And all of us that are on this panel practiced then, and so there are certainly lessons to be learned from it. I mean, I think the thing that I struggle with, and maybe I'm saying what you all are saying, is when is that bottom? I mean, we know that it happened, that all these states within a really short period of time have told everyone to stay indoors, and those things have happened. But when will things start to improve? When will a vaccine be found? When will companies start to be open for business again? To me, that's one of the hardest parts here. And I know we had to deal with that back in 2009, but in that respect, it feels a little bit more different because it's just so tremendously difficult to estimate.
Hey, Andy.
Yes.
I want rebuttal time.
Of course.
I would agree with Gary that yes, in February, up to the latter part of February, the market was at a peak. There's no question. But if you look at the analyst reports, even at that point in time, forecasts were being made for a recessionary period looking forward. And as I said, again, I think there are a lot of similarities with respect to 2009. What happened was the pandemic accelerated the entry into the recession, and I think it's made it a much deeper recession than perhaps it otherwise would be. And that's where I think the distinction lies. In terms of how we deal with it from a valuation perspective, again, I would reiterate what I said before and what Stacy just commented on is I think we deal with it the same way we did back in 2009. You're going to have to make assumptions. You're going to have to do forward-looking projections and assuming different periods of recovery, different growth rates, et cetera. To me, that's no different than what we did before.
So a couple of questions from the audience are talking about that. One question, what's the best way to weight the likelihood of each scenario? What observable economic measures can we look at? Are you looking at these long-term economic forecasts globally? And another question is, how do you guard against a Dober challenge? Any comments on any of those questions?
The answer to all of those questions is yes.
Yeah.
We have to consider everything. You know, we have to do the best we can, and you can weight scenarios. The question's going to be, what are you going to base your weights on other than a hunch? And, you know, can you relate the current experience to the 08-09 recession? You know, I don't think any of us are necessarily disagreeing with each other. I think the concern is you have to be somewhat practical in how you look at this. If you're using the public market, you can't help but ignore multiples in the market. You can't help but ignore, rates of return. I mean, all of this comes from the public market, just like in the 08-09 range when things really hit the fan. So the question becomes, how is it going to turn around? What kind of growth rates are you going to look at? I don't disagree with Harold as far as that goes. I think the concern, though, is we have so many factors that are impacting this so-called recession. We don't know what to expect. What's the federal government going to do as far as passing legislation to possibly help the different states get back on their feet? And various industries getting people back to work. I mean, 6.6 million claims last week for unemployment. I mean, it's a staggering number. What do you do with those local restaurants that are totally out of business right now? We have one that's been around the Fort Lauderdale area for years, They closed because they were considered a non-essential business. They were in a business area as opposed to a residential. So they weren't doing takeout and curbside stuff. And they just announced they're not reopening.
Wow.
I mean, so there's a business that it's gone. And we're going to see a lot more of those, unfortunately, go by the wayside because the owners aren't going to be able to hold out.
Yeah, I know we're talking about cost of capital later in this, but that was one of the thoughts I was having in our whole, specific company risk factor, the idea of less competition. I mean, there may be actual less competition in some certain areas that, so we'll get into that later, but just to piggyback on that comment with people actually not reopening, it is going to change quite a bit. Just circling back to the question on waiting and some of the other things built into that question, my comment back would be, what have you been doing lately? And it's really no different. How are you basing your weightings now or before this COVID? Clearly you have reasons for weighting things heavier, lighter than others, and you need to support that. So I would just encourage those to, again, go back to basics and really think through why you're weighting something, and then how much weight you think you should put on it because of what you know. Okay,
we're getting a few other questions, kind of very pressing, obviously, with the individuals who are grappling with engagements right now. Discounts. Discount for lack of marketability.
There is no market.
Right. Well, okay, but so what how do you estimate that? Is there any data you can look at to back that up, either historically or otherwise? What do you do with that estimate?
I think we have to look at what's going on in the M&A market right now. Harold, you had just sent around some interesting information to our panelists. I think the group would be interested in. But in terms of marketability, are there actually companies being sold right now? And I think that's what we have to look at. And if they are, how are they doing it? And how are they pricing and how are things working out? So I think we kind of need to know what the M&A market activity looks like.
And can anyone get financing for a transaction?
Right
now, the banks are so backlogged because of the legislation, because of CARE, that the question becomes, how do you even try to get a loan right now if you need one for a transaction?
I would not recommend going to the bank for a loan right now.
We have a business broker in the audience who sent in a comment, basically is echoing your remarks. Who would buy a business right now? He says he just had one deal collapse, the second is at risk, and another deal will be just held until we reach a new normal. So that's a comment from a business broker.
Hey, Andy, this might be a good time to share that article from GF Data that I shared with you all earlier, if you wish.
Yeah, please. I don't know if we have it on our reading materials page, but it'll be on our, and I'll announce the link later. We have a special COVID-19 page, resource page on BVR. We'll put it on there, but Harold, yeah, please refer to it if you could.
Yeah. The article I'm about to refer to is the one that Michelle mentioned just a moment ago, and it's by Andy Greenberg, who's the CEO of GF Data, which publishes current multiples in the private equity markets and so on. And the article is aptly titled "Nobody Knows Anything," which I found rather amusing. But the point of the article, he does go on to talk about what is happening in the markets right now. And he distinguishes between different types of deals. For example, deals that have been signed but not launched, people are generally sitting on the sidelines and just waiting because of the uncertainty in the marketplace. Deals that are in the market, he says it's pretty much a mixed bag. Some are taking a wait and see approach. Others are moving forward, but the timing of the transaction is being extended, again, because of the circumstances. And then finally, he talks about deals that are either at or past the letter of intent stage. He says some are on hold, but others are moving forward, depending on whether or not those transactions involve strategic buyers or address what he termed as a mission critical need of the buyer, or were capable of being completed with modest or no debt financing, following up on I think it was Gary's earlier comment. So again, I thought that was a pretty interesting snapshot of what's happening in the marketplace right now.
Thanks very much, Harold. We have another question that's come in that's kind of a little segue actually into the next segment, where we wanted to talk about the government stimulus plan for small business. The question is, due to COVID-19, if sales are suddenly lost temporarily, how does the forgivable loan from the SBA covering the losses figure into the business valuation? Michelle, you're kind of working in this space. What do you think?
All right. How much time do we have? Well, the SBA loans are changing everything, in my opinion. Obviously, for businesses to stay open, keep their people employed. Lots of people are trying to figure out the advantages of the different protections or stimulus the government has provided. The valuation folks who are working within a CPA firm environment or close to CPAs are pretty well in tune with these loans, but I have found that some valuation folks who just purely are valuation aren't quite as knowledgeable about all the SBA opportunities out there and the stimulus that is out there that is going to impact valuation. So I'm going to cover real quick the PPP loan, which is the acronym for the Payroll Protection Plan. This loan is going to basically pay back, if you will, your payroll costs for an 8-week period, and potentially your rent and utilities. If it is forgiven, the PPP loan is a forgivable loan. There's a number of hoops and the application process and how you qualify and how you determine your loan amount is a whole program in itself. But the real key in this PPP loan, which is why every business is getting it or applying for it, is it's forgivable. And so if you do spend the money that you get the loan for, with a few rules associated with it, it's entirely forgiven. This forgiven portion is not taxable either. So I kind of look at it in a sense as somewhat of a revenue replacement, because you're going to still pay your payroll costs and rent and utilities and all your other operating expenses. So in order to pay all of that, if you've lost revenue, this forgivable loan is going to replenish that bucket for you in the businesses. So I'm kind of starting to think about it in terms of a revenue replacement, and it's not taxable. So we're going to have to deal with how to treat non-taxable potential income in our valuation models. Just so people know, every business that has applied for these has had to do some calculation for the banks. So they have had to calculate their estimated payroll costs to get the loan. And many banks are also requiring you to provide the details of how much of the loan you think is going to be forgiven. So I would encourage anyone who is doing valuations currently and definitely ask your businesses if they've applied for this PPP loan, and definitely ask them for their calculations associated with the application itself and the forgiveness piece, because I think you have to look at both of those in your forecasting of what 2020 is going to look like for that business. In terms of timing, one thing I just wanted to point out, so these loans are available until June 30. There's a lot of chatter that the program is going to run out of money very soon. Some banks aren't even accepting any more applications because they've already reached their own caps. So what's happening is the SBA will fund loans to the banks. The businesses don't actually have to take their loan until June 30 or until they need it. So think about the timing. Some businesses may not actually pull their money right now because they may not feel the impact of the COVID-19 yet. So your timing in terms of your modeling, we may have to do like monthly DCFs or a monthly model of 2020 on what companies are going to look like. Once one of these PPP loans is funded, the company basically has 8 weeks of expenses that will go into the forgivable portion of the loan, which again is that payroll piece, rent, and utilities. So that 8-week time, 2 months, that starts ticking, clock ticks the minute they actually pull their funds for the loan. And then I'm told from some banking sources that the forgiveness piece, once you do apply for it 8 weeks down the road, will probably take as long as 90 days for the SBA to approve. So we're looking at about a 6-month probably timeline of when that loan forgiveness and comes off the books. So, this is going to impact how do we determine, looking at our weighted average cost of capital. This interest rate on this is only 1% on the PPP loans, very low interest rate. One really key factor is this is only available for businesses that employ less than 500 employees. So if you're dealing with those over 500, there are some other loan programs and SBA help out there, but this one in particular may not apply. So I think you have to be very mindful if you're dealing with a business right now that has less than 500 employees, how they're dealing with this PPP and what their expectation is going to be critical in your 2020 forecasting.
I've got a question for Michelle. Why wouldn't this be considered to be a non-recurring event? And why wouldn't you normalize it out, including possible expenses that are being carried by the business while the period of revenues isn't there? I mean, wouldn't that all just be part of our normalization process?
But I think it definitely could be. I've also seen some valuations that are in process right now where the business owners are just saying, let's just not even include 2020 whatsoever.
Well, okay, and that's an aberration. I would have a problem with that.
Make it a zero cash flow and then just start the forecasting thereafter.
Well, and that's fine if you have the ability to forecast thereafter. But I think realistically, I can't imagine taking a tax-free loan that doesn't have to be paid back, treating it as revenue for the company, because that's not the operating business. The operating business isn't to take tax-free loans from the government, in which case those expenses that are being carried to offset the tax-free money. There's a no profit factor. All it is replacing your cost of those expenses, in which case it would impact the overall profitability of the business, in which case why not normalize it as just being out of the ordinary?
Hey, if I could chime in here, Gary, I would agree that's one way to look at it. And if I were doing a cap model, I might look at it that way. But if I'm doing a forward-looking projection and a discounted cash flow analysis, I would probably consider what Michelle described in the discrete projection period, because it's actually what's happening.
But where are you going to consider it? You're going to consider it on the balance sheet?
No, I'm going to consider it in my cash flow projections.
But obviously it would be a working capital consideration.
It would be a working capital
as opposed to a profitability.
It would be a working capital issue.
It wouldn't be treated as revenue. It would be treated as a loan that's effectively going to be on the balance sheet one day and it's going to disappear the next. So
during the discrete projection period. To me, you could factor it in that way.
You're going to create value by not paying back a loan?
Is it real money?
Well, that's almost like saying you capitalize depreciation and create value.
Well, I think what you're all saying is it's a source of cash flow that doesn't have to be repaid back. I mean, it doesn't matter where you put it in your model. It's a source of cash flow that offsets the expenses in this period that's full of uncertainty. I think you're all agreeing with that. How you frame it in your model probably doesn't make much of an impact, especially since it's not taxable.
Right. And I didn't necessarily mean I would treat it as revenue and book it into my projections as revenue per se. I'm looking at it from a pure cash flow perspective. It just conceptually seems to me that it does replace a revenue stream for these businesses that are struggling or don't have as much activity but are still keeping their people on board. But I think it's ultimately going to go into just our debt-free cash flow calculation, probably as a separate line item somewhere along the way. I don't know. We haven't thought through what the model is going to look like yet, but it's definitely cash flow. And I think you have to look at what is going to happen over the next 6, 9, 12 months with these loans.
I would think that the loans could be a contra account to the expense. Have it as an offset to the expense, because you wouldn't keep the payroll going. You might not pay certain expenses, but for this loan.
But the loan is tax free, so you can't do it directly against the expense because you're still going to get a tax deduction for those expenses.
You can calculate the tax benefit of that.
Yeah, I mean, the tax benefit would have to be determined, but.
Yeah, I mean, the short answer is it's not an easy answer.
It's not an easy.
One thing that you're pointing out, Michelle, that I think is an interesting nuance is, while it sounds like this is a great thing and this will be a source of cash flow for people, it's not necessarily clear that everyone who's going to apply for it, even if they qualify, is going to get the money. So, if the bank runs out, if the funds are exhausted, it's going to take a little while for all that to flesh out. But that's another risk that could be real for some firms.
Right.
Well, it's not only that they won't get the money, Stacy. It's also a matter of they may have to pay it back if they do, because it's no guarantee that they're going to be forgiven.
Right. There's definitely some rules associated with calculating the forgiveness portion. But the nice thing about this PPP is, even if you do have unforgivable portions of it, it's a 2-year loan. So they're looking at it like a working capital loan almost for 2 years. You don't have to start making payments for 6 months, and it's at 1% interest. So it's very cheap money, even if you don't have the ability to have it forgiven. I know some businesses who have laid people off. They don't have any employees right now. They don't intend to hire their employees back anytime soon. And they've applied for the loan, and they may actually take the funds when they're available and not have a forgivable portion and just treat it as a short-term 2-year loan to get through the next few months. So there's a lot of play going on, lots of gaming, if you will, by a lot of businesses and how to take, their rightful advantage of the program that the federal government has provided here. There's definitely concern about banks running out of money, though. I think most people probably saw Wells Fargo shut their application process down, announced that on Sunday. And this thing just went live on Friday. So the one thing that's interesting about it is sole proprietors and independent contractors are also going to qualify for this loan, but they can't apply until this Friday. So the small guys had to wait a week, and I just feel, I'm not sure why they did that. I think they still have to get some provisions worked out around the sole proprietors, but they will also be qualifying for this. It's not just entities.
I While you were talking, a comment came in from the audience. It says, banks are not canceling financing already approved. Buyers are the ones going on hold. However, banks are busy, hence not looking at new deals. Is that a fair statement?
I think so.
Yeah, absolutely.
Okay.
Banks are so overwhelmed right now. I'm on a bank board, and we've been communicating daily on the board level, and our people have been there until the wee hours. The SBA program itself, this is a lot like the unemployment for those who have the online unemployments in their states. People can't get in. They have to do it at 3 o'clock in the morning to make the application, and even if they get on, they can't get the whole thing completed and they get zapped out. The same thing is happening with banks trying to submit the data into SBA. They have to do it at midnight, 1 o'clock, 3 in the morning, whatever it is, just to get things through. So it is just completely overwhelming the banking system right now.
Great, thanks. Why don't we, does anyone else have any other comments or remarks about the government plans or anything else?
I do have one other, I focused everything on this PPP loan, but I did want to mention for some companies who aren't doing the PPP or for whatever reason, there's also considerable benefits being allowed for payroll tax deferral. Companies don't have to pay their payroll taxes this year, basically. They can defer them and pay 50% next year and 50% the year after. So, talk to your businesses and find out, are they taking advantage of that payroll tax deferral? Because that could change your forecasting. There's also, with the sick pay, the FFRCA, what is that? The Family First Corona, I can't remember the whole acronym. The addition to the FMLA, where you have to pay 2 weeks of sick time in most cases, up to 12 weeks potentially. And that is all going to be fully funded by the federal government as well. So it's not just this loan, there's a lot of little payroll associated changes and opportunities for businesses to take advantage of, and just be sure you're asking your businesses what they're taking advantage of and what they're not.
One more question came in from the audience, just maybe to finish up this little section. The question is, would it be fair to say any of these loans make the difference between a going concern valuation and a liquidation value analysis? Yes.
I'm gonna tell you right now, every business, whether they are open, teleworking, closed, whatever it is, they are all applying for this. And most professionals, CPAs, bankers, whomever, are advising their businesses to do so, because right now, as we sit here today on, April 7th, we don't know the impact this is going to have on our businesses a month from now. And so if we don't get these loan applications in now and secure the funding, we might be out of luck. So I can tell you, whether it's a going concern or not, pretty much every business that I'm aware of or that I work with is applying for this.
But another issue that you touched on when you spoke a few minutes ago, Michelle, was that I think some businesses are trying to figure out that push point between, if I borrow the money and I keep the employees and the loan is forgivable, how does that compare with my cash flow if I just lay everyone off or I furlough them? And those are uncertain questions, to be sure, but I think just before you even get into the issue of the loans, that principal question of, I agree, a lot of firms are going forward and borrowing the money or trying to borrow the money, but do you even try to retain the people? Do you lay them off? And where is your best, most optimal situation? I mean, it's very important.
Well, don't forget too,
think about the hair salon that lays off all their people as non-essential as a non-essential business. And they get this loan, they continue to pay their people, but they still have no revenue coming in because customers can't come to their shop. So how could this loan create any kind of value, even if you're considering cash flow? All it's doing is a little bit of a safeguard to keep the outflow from getting worse than it is. It might just be the difference between a going concern and a liquidation scenario. But it certainly doesn't create value when the business is closed.
I guess the hope in the example that you just gave of a hair salon is maybe it gets them in some cases over the edge. With some luck in some jurisdictions, these things start reopening. When? I don't know. Is it June?
Exactly.
Whenever, there plenty of people are still going to want to go get their hair cut or treat all of us that can't get there right now, right? And so there'll be hopefully a deluge of people that are in line when those shops reopen. And
I get turned gray while I was waiting.
maybe it'll be enough to keep those shops their ability to reopen whenever that day comes.
Right. I think that is a big question that's going around, is the pent-up demand. What's the impact of the pent-up demand in the businesses that we're looking at? That's a big question. And another comment, Stacy, piggybacking off of yours in terms of what's the best way, what are the push points, what are these businesses looking at? In so many circumstances, for slightly lower paid professions or jobs, it actually made more sense to lay your people off to take advantage of the extra $600 a week in unemployment that the federal stimulus package allowed for. So I know in Michigan, the highest Michigan portion is about $395, and you add the $600, that's about $1,000 a week. And you can be on unemployment for up to 13 weeks. So some employees don't want to go back to work to help the employers get their PPP loan forgiven because they're making more money sitting at home and collecting their unemployment check. So,
assuming their application goes through, which is a big question.
Yeah, good point.
Florida is now printing paper applications because the online system just kept crashing.
Right. When I think that too is, Gary, you had mentioned earlier the huge increase in unemployment claims filed last week. That's not, to me, that wasn't a surprise because that was right after the CARES Act came out and everybody learned of their extra, the whole point was, or part of that whole act was to either encourage people to lay their people off or to keep them employed. So I wasn't surprised at the large increase in unemployment, primarily because of that extra $600 kicker. I mean, who wouldn't?
I think we're going to see it get even bigger potentially, only because with all these systems crashing, I don't think the government really knows what the real statistics are of all the people that are even applying.
Right. I think the numbers aren't necessarily real because of all the different games that people are, I hate to call them games, but
they're not games. I mean, people just can't even apply at this point because the system's so overwhelmed that even employers that wanted to keep their people on for a little longer than they could finally just had to bite the bullet and say, I just can't do it anymore. And we're seeing the numbers grow for that reason.
Thanks, everyone. And if we could maybe spend some time on the three approaches to value. I know we've touched on some of it, but anything else? I got a question from the audience on market multiples, but on an overall basis, in the income approach, in terms of, maybe you can give me your overall impression on this. Our valuation equation, the numerator and the denominator, where we spent so much time on the numerator and denominator before, where should that mix be now, given that cash is king, possibly? Any kind of a percentage breakdown you might want to opine on? Is it 40% on the denominator and 60 on the numerator, or what? Any sense?
I'll defer to Harold on this one.
I don't know that I can give any specific guidance with respect to percentages that I would place on the weight in the numerator denominator. But what I would say is that I think you need to consider all of those components. You're going to have to look at, as I said earlier, you're going to have to look at cash flow projections. I think you're going to have to do alternative projections, taking into consideration different scenarios. I think you're going to have to look at the discount rate, which, as everyone knows, reflects the risk of achieving those expected future cash flows. So I don't think you can take one in isolation. I think you have to look at them collectively. And one thing you do need to be careful with, for example, is, if you are embedding your consideration of risk in the discount rate, and then you go and do a weighted probability analysis, again, the weights that you're using to reflect achieving those different scenarios, again, is a measure of risk. So you have to be careful to avoid double counting there. So again, I don't think you can take any one in isolation. I think you have to look at it collectively.
Yeah, Andy, one thing I think that all of the viewers need to consider, one of my pet peeves with our profession is that everybody becomes very mechanical in what they do. Everybody either builds up a discount rate or they use CAPM, and everybody's worrying about, should I use the spot rate? Should I use Duff and Phelps rate? What should I be using? And everybody is so mechanical that they're losing sight of our goal is to come up with a supportable discount rate, which is what is the risk that we're not going to get that cash flow? The only thing this is proving to us is that more and more of the cash flows may start looking like venture capital or much higher risk, maybe junk bonds. And I think we have to consider, forget about the different layers. We have to consider the end result and say, does this make sense in light of whatever the forecast is?
The challenge with that is we don't know when that bottom is happening. Just to reiterate something we said before, listening to you, Harold, and you, Gary, in terms of what you both said, when you see some light coming out of the tunnel, it'll be a little bit easier to deal with this. But it's so difficult to discern that right now. We'll be in a significantly different place, I suspect, in terms of our ability to estimate, even though it'll still be hard this summer or even in a month or two, once some things start to emerge about when businesses will come back. And even though there will be uncertainty, I think it'll be a little bit easier for us to get our hands around these things.
Following up on Gary's comment earlier about going back to fundamentals, I'll go back to Revenue Ruling 59-60. Valuation is a prophecy as to the future. There's no certainty. We have to make reasonable assumptions, justify those assumptions, of course, and make sure that they're credible. But nobody has a crystal ball here.
Well, I'm wondering how many people will truly have a valuation come in the next week or so that has a valuation date of February 29th. I mean, so I'm sort of going off Stacy's comment on this summer. We're probably going to be dealing with valuations this summer that have to deal with valuation dates that we're talking about right now. And we're going to know a lot more in the summer and be able to deal with it. But, it'll be interesting maybe to go back and watch this recording if we have a valuation that's done in early April or has that date, to know what did we know and what were we thinking at that point. But unless and even, I can think about estates will have estate valuations, and gifts may have some dates that are in this time period, maybe some transactions, some ESOP transactions. I'm just trying to think what other kinds of transactions will we see needing valuations in this kind of window of time of uncertainty.
perfect opportunity to use the alternate valuation date for estate valuations.
Exactly what I was. I was thinking the same thing for somebody who died 6 months ago.
I have to believe a lot of people are going to want to do estate planning at dates right around now. Just touching on what you're saying, Michelle, though, those will be the ones perhaps that people will be dealing with dates as of this time.
We had a question from the audience about, is this a good time to make gifts?
Yeah.
Yes. Yes, indeed. Although I will say I was challenging some of our people the other day when there was a comment from the group on, wow, businesses are all worth 30% less right now. We should be encouraging whatever, gifts or whatever it is. And I said, well, don't be so sure. Just because the public market is down, I don't know what it is currently or even today. My general experience is the closely held privately owned companies are not typically, in my experience, feel the same effects as the public market do. So I said we really need to challenge ourselves on specific companies and how it's impacting them.
The only thing, Michelle, that we have to also consider is the fact that if in fact we're looking at the closely held businesses, what we did see in 2009 is merger and acquisition activity came to a grinding halt. Mm-hmm. I mean, there's certainly a marketability element because things aren't as marketable as they have been. They may not be impacted as much with the multiples, but the fact is they're just not selling. And I think we have to be practical as we're valuing these businesses to recognize we have to be careful. Back in 2011, people would go back 5 years and do some sort of a weighted average and saying, does that make sense when you had 2008, 2009 in that mix, when it probably wouldn't be in the foreseeable future again? We may look at this time period as not being in the foreseeable future again. Right. And we have to be very careful and not become mechanical in what we do. We really need to think about it more than ever before.
I got to follow up to what Gary just said because there's a timing issue. Going back to that GF data article that I mentioned earlier, they looked at the 2009 time period, and what they saw was that in the first half of 2009, the deals that represented a flight to quality, solid deals, continued to take place at high valuations at that point in time. What happened was that the transactions that were not quality deals, if you will, tended to fall by the wayside. In the second half of 2009 is where you actually saw the decline in deal pricing, debt loads, et cetera, that reflected the market conditions. So there was about a 6-month delay before you really saw the impact in the market on transaction multiples. Speaking
of mechanical inputs, we do have a poll. We have a poll open. Our audience is taking it on inputs that they're using for December 31, 2019 valuations. It's been open for a while. Let's close it. We're getting, historical ERP, 23%. Recommended ERP, Duff & Phelps, 23%. Implied ERP, 5%. Other ERP, 3%. Spot rate, risk-free rate, 23%. Normalized risk-free rate, Duff & Phelps, 15%. Other risk-free rates, about 8%. Does that surprise anyone, or any comments on any of that?
I think probably I was going to say the December 31 date, valuation date. I don't find it too surprising. I am always curious to see what other valuation professionals are using, especially since the recommended Duff and Phelps stuff came out way back as well, and a lot of people jumped on that years ago. So I was very curious to see if anybody is how that split. So
one question: should valuation people be looking more towards these forward-looking measures? I mean, we have the implied ERP from Professor Demoteran. Is that something that might change given what's going on?
Truthfully, I personally think that we concentrate so much on the various components of the discount rate and not enough on the discount rate. They're using forward-looking, historical-looking, some sort of recommended. Who cares? At the end of the day, what we really have to worry about is, do we have the right discount rate? Is the required rate of return appropriate for the stream of income that's being forecast?
What about a more of a looking to survey-based methods? For instance, what Pepperdine University is doing in terms of, I know it's not data, but it's information related to what are required rates of returns of various investors, banks on various private entities.
It makes a nice sanity check, but it's not empirical data. For those of us who do a lot of litigation work, if you're concerned about being Dalberted out of the case, that would be a good way to get Dalberted out of the case, to start relying on surveys or some form of anecdotal evidence as opposed to empirical evidence.
Yeah. Andy, to follow up, I mean, what we do is we generally compute the discount rate for the cost of equity several different ways, and then make a judgmental determination as to the final rate. Going to Gary's comment, you look at the total rate of return, what makes sense. As a basis of comparison, we then look at the public markets and the total rates of returns for equity, for the various sizes of companies, more or less for us, typically would set the floor for the discount rate for a closely held business. On the other end of the spectrum, as a ceiling, we would look at things like rates of returns demanded by private equity firms, venture capitalists, and so on. And somewhere there's the sweet spot, if you will, or a reasonable range that your total cost of equity should fall in if you've done the calculations appropriately. And again, agreeing with Gary, God, it pains me to say that.
I love it. And it's being recorded, Harold.
It's like the third time.
The ultimate three times? Oh my gosh. The ultimate focus is the total cost of equity.
Stacy, a number of years ago, you did a program for us on cost of capital during troubled times. Any comments you could make to us on that?
Well, it is interesting. The more things change, the more they seem the same, right? I mean, we were having the same debate then as your poll just indicated. Do you use the spot rate? What do you use? Duff and Phelps? Do you use some other measure, risk-free, or what do you do? How do you adjust all these things? And touching on, I think, Harold, you said a little earlier, I mean, to me, one of my biggest concerns, I agree with what you both said about the number needs to make sense, but it needs to make sense relative to the benefit stream you're using. So if you're using weighted average cost of capital, you have a number of inputs. You've got, assuming you're doing a build-up, you've got the risk-free, you've got the ERP, you've got the specific company risk, you've got the benefit stream, you've got the cost of debt, you've got the weighting. And so I suppose perhaps the most important thing is to make sure that you consider each of those and not try to overcompensate one versus the other. If you're doing a scenario analysis, as Harold suggested, and you have a very significant high discount rate, then then how does that factor into your economic benefit stream that you're considering? Another issue, just in terms of all of that, is touching on what Michelle said, is the proportion of debt. The proportion of debt, you may not be able to necessarily look at history given these various government loan programs we're talking about, although a portion of that debt may be forgivable. So, I mean, at the end of the day, I think I'm going to be calculating my discount rates the same way I always have. And if there's uncertainty, I'm going to have to consider whether I make an adjustment to my specific company risk premium. I mean, that was something that I did back in 2009, and I'm sure I'll do the same thing here. But there are these unique nuances right now relative, I think, in particular to the debt cost and the proportion of debt. And by the way, one other thing, people may decide on a going forward basis to change or modify the way they run the business. Given everything that happened, business owners may decide to run their businesses more conservatively, adjust their required levels of working capital, borrow less debt, have more cash on hand. So all of those things, I think, factor into the assumptions that we're talking about.
Terrific. Any other comments on that?
I just wanted to comment on the debt piece of it briefly. I spent a lot of time talking about the PPP loan program. There is an additional loan program, the Economic Injury Disaster Relief Loan through SBA, and that is another option for businesses. You can get both. There are some rules associated if you do have both. But this is another one that is a very generous loan. It has it could potentially have a 30-year AM, a low interest rate, and companies who take advantage of that or had the opportunity to take advantage of that, we may need to build into our considerations in our WACC in terms of what, whether it's fair market value or investment value. In a company, the interest rates are low, and do you have to put yourself in the shoes of the business owner? Should they have applied for it to get something different, or how does it compare to commercial lending, and whether or not we need to take any of that into consideration is going to be a question for some people, I think.
Well, thanks very much. Speaking of the 08 recession, we just launched a poll asking if any of our audience were practicing valuation during that recession. 56% yes, were practicing valuation during the 2008 recession. Interesting. 44% no. So there's certainly something that can be learned from history. As a matter of fact, on our BVR resource page for the virus, we've got a bunch of historical webinars and articles, some very interesting things from that time period that may be helpful to our audience, talking about subsequent events, or Stacy, your program on cost of capital. So we have the link to that on our reading page. So let's move in. We've got about 10 minutes or so left. We could talk about a few family law considerations, if we could. I know, Michelle, you lead the practice at your firm. Question from the audience: any special considerations when doing valuations for marital dissolutions during the crisis? I think we touched on some of this. Anything else, Michelle?
I'd circle back a lot on the valuation date. I think that's going to be a key factor. I think, if I'm a business owner, I'm going to have a really hard time settling my case right now based on a December valuation date. It is very state specific in terms of valuation. So obviously, your state rules, but I think we may have to look at scenario based, like Harold's been talking about. Oftentimes I'll do I call them the sensitivity analysis, where I'll run different levels of cash flow and different levels of rates of return and do a grid almost and show them where on the grid they are based on certain assumptions, just to give folks some choices in trying to settle cases. Now, that being said, the courts right now are closed. So there's not a lot of trials going on right now, for sure. However, I have been involved in some mediations and arbitrations through Zoom or other online platforms. So cases are still moving forward to some extent. I'd be curious any of the other panelists how their family law cases might be going. But it's been a real challenge to come up with something that a business owner in particular is comfortable with in terms of a value and or a payment stream. Giving them options on values is helpful, and also giving them values to, if they're desperate to settle this thing right now, maybe you have a look back period in 6 months and or something that you could potentially go back to. So on the valuation side, it's kind of the same as any other thing we're experiencing, even in the M&A market. The income side of things, income for spousal support and child support, is a whole nother can of worms that people are trying to figure out right now. We've relied so much on history, looking at income potential, reasonable compensation, the whole double dip argument. Those are all open for discussion. They're all changing. The income piece of it, especially if people have been laid off, replaced it with unemployment, and those are for obviously lower income folks. But family law attorneys are really looking to us for some guidance on how to deal with some of these income issues, not necessarily for the higher net worth folks. So, educate yourself as best you can on your state's unemployment and the federal unemployment and income levels, what they're capable of potentially making. And then, in Michigan anyway, when they're looking at support, you can have income imputed to somebody who isn't currently working, but you actually have to also show that they can get a job that pays that or something similar. So now, now that the jobs, as we sit here today, aren't really there, how's that going to impact it? So, while the courts are closed and things are kind of shut down, I think most people are just going to sort of wait this out in a lot of family law cases. But again, those who want to move these forward and maybe the not quite as litigious ones, we can help them keep moving them through.
From a practical standpoint, one of the things that we've done is we've reached out to a lot of the family law attorneys that we deal with, and we've reminded them, even in those states that have a presumptive date for the valuation as being the date of filing, we're actually asking them to reach out to their clients and discuss with them how this has impacted their businesses currently and whether or not they should be filing an application with the courts once they're available for filings to see if they can move the date on the basis of equity to a more current date.